I gave you both sides of the marketplace. That means you're looking at both ends of the session, because session draw on liquidity, session liquidity is above and below. It's above and below. All you have to do is wait. Wait for them to do the damage. Wait for them to do what's the time window? Well, you're gonna see it at 10 o'clock. That means you have to wait that first 30 minutes. Why? Because that is the opening range. That's that vertical line right here. Okay. So when you're watching price action, you're looking all through that first 30 minutes. Your eye is going to, where is the initial legs of liquidity? We gave them to you. Here is the buy side, and the sell side was over here. Here and here. And how far could it reach down, Michael? Remember I was telling you that? It can trade down to that new day opening gap. It can trade down into that. And if it's going to trade through that, we have that lower here, which was in view when I was showing you all this stuff anyway. Then, once it does that, it rallies back up to opening range gap, closes it in, drops one more time, overlaps into all this, the rejection block. You heard me talk about that as it's happening. Come back down, hits the new day opening gap from the 16th, rallies back up in. Look how the bodies are staying here. Remember I was saying, listen to this part, okay? It's spending too much time. It's spending too much time inside of the opening range gap. Meaning what? They're not in a hurry to pierce this high, much more meaningful than they did here. So this high and this high is still relatively clean. That's just tiny. It's little. That's a little bit of movement. It's just like when I was telling you the description when your child's coloring, they color outside the lines. You don't look at that as a failure. You don't say, look what you did that wrong. And smack them for it. You're going to hang it on your refrigerator because it's your child. Well, same thing here. When the algorithm is trading just outside of the lines, it's okay. It's doing everything it's designed to do. To get that price high booked, it's got to go above it because there's a spread. Well, that's all it did there. Did it close above it? No. Did it have much more meaningful movement beyond that? No. Did it trade to the high of the new week opening gap for August 18th, this week's new week opening gap? No. So what is it leaving? It's leaving this liquidity and making these individuals over here feel safe. So what is it going to inspire if it sells off? Shorts to do what? Place their stop loss above here, or if they have deeper pockets, build it right there. So this is engineering liquidity. It drops here. I said take your attention over here to these wicks, here and here. We watched it drop down below it, took out that low. And now I said, now watch. What I want to see is, does it get back above the new day opening gap on the 16th? And then does it come back down and touch that there? Yes. I don't want to see it trade down and below that wick's consequent encroachment. It never did it. Right there, that tells me, and this is what you're supposed to be doing by listening to that you didn't pay attention to because you're looking for something else or you're waiting for me to say something that's going to resonate with you. I'm teaching you how I called that institutional order flow entry drill. How did you know? If I show you all the comments from me uploading that video earlier this morning where I got in the trade, how did you know that? And why are you trading before? Weren't you supposed to wait for relative equal highs? Weren't you supposed to be waiting for relative equal lows? Again, you don't know what I'm putting the content out there for. I'm addressing individuals that are paid students. How can we, that know a little bit more than the average bear watching my channel, how can we use this model if we don't have a model that we've really warmed up to? Specifically, 2016 students. I have 2016 paid students that can't find their way through this still. No matter what content I bring forward, no matter how many people are making money with it, with real money, with real results, proving it is happening, calling it live, they can't make it work for themselves because there's some kind of a barrier. But their question is how can we, I know that they know a lot more than Caleb does. But the questions are, how can they use this methodology and understand how to use the range that was formed in London? If you go back and listen to what I was talking about, if you're brand new, you don't know what you're doing, and like I'm telling Caleb, you don't worry about this. You don't worry about this. You wait for 7 o'clock and then you look for relative equal highs and relative equal lows. Well, guess what? That's this, folks. That's the relative equal highs after 7 o'clock. Right here. Here's 7 o'clock. Okay. It rallies. We're waiting. We're waiting. We're waiting. 9:30 opening bell. All the way to 7 o'clock. You're going to look back through that. So if you're going to not be an early trader, you're not trying to trade early. You're going to start looking at the market at 9 o'clock. Go back to 7 o'clock. So you're looking back through the last 2 hours. You only have to look back through the last 2 hours to see where the liquidity is. So here at 9 o'clock, right there, what do you have? High that's lower than that. Isn't that a relative equal high? Listen to the definition I gave you in the previous teachings. Yes. What are these? Relative equal lows. So what is it doing first? It runs above these highs there, and then creates what? Another smooth relative equal high. But then what does it then do after that? It breaks lower, takes out the liquidity here, and we're watching the opening range. What's it doing? It's finding responsiveness at the midpoint. It has no ability to get to the upper half of it. So what's it going to do? Go back further to 7 o'clock. Anyone that has more advanced understanding, listen to the lectures I gave prior to this week, where I'm talking about the relative equal highs and relative equal lows, and I'm telling Caleb, you only wait for the 7 o'clock and anything that forms to the right of that. I have students that will be able to use the information that is in price action prior to 7 o'clock in the morning because they know all the things that I taught them around London and how they deal with the opening and closing of a daily range, power 3. They're going to incorporate that part of the range. So that lesson was just simply me saying, this is using Caleb's model, and you know how to use the other stuff I taught you with London. The things I'm talking about and referring to that are already on the YouTube channel. Go watch the mentorship videos in 2017. The 2017 mentorship playlist. The students that paid and went through those lectures live as I was delivering them, as it was happening, and I was doing live streams and calling markets and saying this is what's going to happen, doing market reviews, saying where it's going to go next. Those were the individuals I was answering and addressing to there because they want to know, is it anything here for them or should they just stick with what they got? And I have students that don't find their way well through the marketplace still because they have something, and I don't know what the barrier is for all of them. I don't know what it is. Okay, sometimes, they're very clear in showing what it is, and others are just, I don't know, I don't know if they're just guarded and they won't be honest with me and say, this is what I keep doing, but I haven't been willing to show you this. I keep making this mistake. So if you're going to ask me as a student, and I'm not saying you should do this because I still get emails from people all around the world saying, hey, look, can you tell me what I'm doing wrong? Or can you look at what I did here and tell me I did it right? I shouldn't have to do that. If the outcome was positive, you did something right. If the outcome was not positive, you didn't do something right. So explore. I'm not going to cut you to the front of the line of your learning curve by doing it. And I know some of you just want an interaction with me on an email like I'm a celebrity. I'm not a celebrity. I'm not important. I'm not that great of a person. Just be content with what I'm teaching you here. Stop trying to lift me up to a celebrity status. I'm not that. Amazing. Okay. But anything prior to 7 o'clock, well, what does that take you back to here? There, which is what I referred you to when we were entering into that 9:30 opening. Where's the liquidity at? Here and here. And what did the market do? It addressed what side first? Here. After 9:30. That's here. Right there. So did it go for that liquidity or the sell side over here? Which side did it go for? It went for the sell side first. Came back up. Did it take that liquidity out yet when it was here? No. Did it take it out right here? No. So where'd it go? It went below one more time here. We were looking for it to sweep down to here. Then as it was dropping down, I said, watch these wicks in here. It overshot the entire low. That's fine. We're not in a trade. We're not getting stopped out. We're not getting squeezed out. We're observing and watching. What are we waiting for? We want to see it take that low out. Drops. What is this forming? Relative equal lows for anybody that's trading to 9 o'clock. Going in, waiting for what? The first 30 minutes opening range. High, high. Relative equal highs. In an area I told you this is going to be problematic. We need to study this. It's going to need to get through this little area here because there's two indecisive candles. Even though that this candlestick's closed and this candlestick's open, is basically symmetrical. It's close. It doesn't really provide a gap. When I see candles like this in the middle, two of them like that, that to me is something that needs to be repriced to. And if it goes through it in the direction I'm looking for it to move, then I'm fine with it. Then I'm going to disregard it and never worry about it again. But go back and listen to it while we were trading here. I said it needs to go through here. And it couldn't do it. Went lower, lower, rallied one more time. The body's staying inside the opening range gap. Just bumped that high and then took us down to clear this. I told you once it done this, I want to see it trade above the new day opening gap on the 16th. Come back down, touch that, and it did. And then I gave you, because of all the things I just outlined, which side did it work predominantly? The sell side. What is the side of the marketplace usually offered to the public first? The wrong side. They take them down the primrose lane. Okay. There was a song my grandpa used to listen to. I don't know the artist. It was an old singer, but he used to play every time he would get drunk. He would sit there with his boxer shorts on, nothing else on. Despite, well, that's not true. He would wear white tube socks and a pair of boxer shorts, his underwear, and he'd sit there with a half a gallon of ice cream, butter pecan, smoking Lark's cigarettes, and watching Gomer Pyle, drunk as shit. The TV would be on, and this guy would be singing something about going down the primrose lane. Well, in the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going. I want to get on board, and they chase it. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you as a student. Okay, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry, Joe, and we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still unfilled? Of course it is. That's exactly what you want to see as a signature. That is the algorithm tipping its hand to me because I know what the fuck I'm looking for. When it does that, it's going to be what I want to see. We want to see it rally up. Where is it going to rally to, Michael? New week opening gap low. And then we want to see it trade into the midpoint of that consequent encroachment. And does it touch the top of it? Look at the bodies respecting it again. Yeah, we wicked through it. And admittedly, when I said 6, yeah, boom, it happened. I thought because it flashed real quick, my eye was watching that. This line, I thought that was this over here. And it had to dig down. And I told you, okay, I want to see it go down into this area here. And there's a balanced price range in there. So it can do that and then send it higher. Does your chart show this? I'm quite fucking certain that your chart, if you have live data feed right now, or if you're watching it after the fact, you're now looking at the same thing that's on this chart. But if this is the daily range, okay, not a candlestick, but an open, high, low, close bar. So this is the open. This is the lowest it made for the day. And this is the highest it made for the day. And this is where it stops trading, okay? If your thinking is that we're probably going to move up over a series of days or for the week or for the month, or we're moving in that direction higher, okay? And you're watching price action at 9:30 here. And you've defined, as we did here, the sell side was here. We incorporated that old new day opening gap, and we gave you the buy side. So if we're opening right here at that candlestick's tick opening, let me go back over here. If that opening price on that, I'm going to move this vertical line so you can see it better. So that opening, we opened, went up, closed down. That opening right there represents this graphically in my diagram, okay? And then from that opening price, that movement from here to that low would represent that low on the daily open, high, low, close bar. So what we're saying is the open and the initial drop down, that's the fake move. That's the Judas swing. That's where smart money buys.